All right. Thank you everyone for being here for our final roundtable. This is the fifth of five that we've done this year, including two guest presenter presentations by Ron Buck and Ralph DeLeon, who spoke with us on various aspects of exit planning, more from the side of the business. So we've really been talking about exit planning for business owners from the side of the business, how to increase value, how to be prepared for sale, things to consider as you're selling your business. And those are the topics that we've been delving into all year in the roundtable. And now we get to the one that is probably the nearest and dearest to my heart, which is how you take take that illiquid asset, your business, your baby that you created, over a period of years, maybe even decades, and it's like one of your own children. And how do you really turn that into what you need for income for the rest of your life? And as well as considerations on more the emotional side of planning that need to be considered. It's a huge shift as well. So we're going to be looking at those things. I'll go ahead and do my screen share so I can pull up my slides and hopefully you all can see the slides. Um, and so, yeah, we're doing personal financial planning for entrepreneurs, maximizing success post-exit today. A little bit on GenCrest Capital Partners, the firm that I work for. I'm the Director of Financial Planning Services here. I've been with GenCrest for 7 years as of this recording, which is December. Actually, I just had my 7th anniversary, so I've been with GenCrest, formerly Hutchinson Family Offices. And in that time, my role has continued to grow and shift from more of a just tax-focused role to more of an overall investment advisor role with a special niche in working with business owners on their exit transitions. Overall, our company offers family office services, private wealth services, tax planning, business exit planning, which we're here talking about today, and divorce consulting. So our agenda for today, we're going to talk about the three-legged stool. And if you're not familiar with that yet, it's something we covered very early on in Roundtable. But if you're not remembering what that is, or that's a new concept to you, we'll be talking about that today. We're going to be looking at the demographics of our owners, sort of by generation and considerations for the demographics around exit planning. An overview of shifts that you have as you approach exit and then post exit. And these can be financial and also emotional. Calculating your estimated take home number, and then the business owner's financial plan. So I've been in financial planning for 20 years now and have worked with a variety of people, and business owners they really have very specialized financial planning needs. So I'm going to be going into an actual real life example using the software that I use here at GenCrest for personal financial planning and how that can be used for a business owner getting prepared for transition. And lastly, time for questions and reflections. Over here on the right, you'll see on this slide just a disclaimer that none of this should be considered specific tax, legal, or accounting advice or financial planning advice. You should consult your own advisors. Everyone's situation is unique. All right, so jumping in, we're looking at the three-legged stool. So whenever, it's like we all should have our elevator speech about what we do. And when I talk about the exit planning, this is where I start. I say, we want to think about the three-legged stool approach that owners need to have when they're considering a transition. And again, we've really been focused on the business. How do you prepare the business for sale? From a legal perspective, a tax perspective, your internal employees, how do you look at improving the value in your business so that you can maybe have a higher number, a higher multiple that you can get to? And then on the other two legs, and you'll see that there are two legs of the stool, we have the personal and the financial planning piece for the business owner. So the personal is more, the goals and role and identity. And then we have the personal financial piece So those are really the three important parts. So we're focusing on the personal and the financial today. In preparing for today's presentation, that's a lot of P's, I took a look at a great study. I'm a certified exit planning advisor, and that's a designation that is given out, not given out, it is earned through the Exit Planning Institute. It requires ongoing education. It's an organization I'm really engaged with as a CEPA. And they put forth this study, 2025 Generational Owner Readiness National Report this year. So I wanted to pull a little bit of data from this to see who they interviewed more than, I think it was 1,100 plus business owners all over the country to look at some demographics on who's planning to sell their businesses in the next 5 years. And you can see, not a big surprise at this time, that we do have the majority of our business owners looking to sell are our baby boomers. Those are the ones that are maybe already in retirement age. I would say, in their mid 60s. But maybe surprising, not surprising to me, because these are oftentimes the owners that I'm engaging with as well. We can see that our millennials and our Gen X are also considering sale. And this is what I see a lot of. I work with a lot of owners, certainly that are in their 60s that are looking at selling. I've worked with owners in their 70s who are finally ready to sell. But a surprising number of the clients that I'm engaging with are younger, and they're looking at a company that they've sold. Sometimes something's, they want to be prepared at least, which is another thing we've talked about in Roundtable all year, that exit planning doesn't mean that it's necessarily even right around the corner. It's just part of the business planning that you do. And a lot of the younger owners that I'm engaging with, they at least want to be prepared that if they get a good offer, that they want to understand what that offer is and what that means for them for their own personal financial planning. So this slide, again, this is from this generational owner readiness report, shows, certainly everyone needs a team. Only 13% of the respondents to this study have a formal exit plan. Despite that, 58% of baby boomers are planning to exit in the next 5 years, but only 5% have a formal exit team. And I would consider a formal exit team, a bare bones team, to be your attorney. That could be a business attorney or an estate planning attorney, your CPA, your financial advisor, and then also possibly looking at a value acceleration specialist that can really help focus on growing the business in preparation for sale. Can see that, again, exit planning is business planning, but a lot of owners have not completed any sort of pre-transition value enhancement or looking at ways that they objectively, we talked earlier on in Roundtable about ugly baby syndrome. You got to think of an owner, it's like selling real estate, selling your house. It's your baby, but you got to really approach it as how this looks to an outsider, even if it's an internal buyer. How does it look to the buyer to potentially buy? And that's where it's a lot of people are not doing this level of planning to look at that on the front end. Only 9% of business owners have no plans at all for their exit. So we know that owners are at least thinking about exit. I don't know any owners out there that are planning, they all have some idea that they're going to transition out. This again from the same study. At the bottom of the first paragraph here, we can see in 2023, 68% had sought outside advice on their exit, up from 38% in 2013. So the Exit Planning Institute has done a lot of work on this. They had a study that came out in 2013, and then again, another one in 2024, this 2025 study that was more generationally focused, where they are seeing that more owners understand exit planning as a concept. Exit is not a four-letter word. It is a four-letter word, but it shouldn't be considered a negative word. It's really just good business planning, and that more owners are at least realizing this and hopefully wanting to make the right steps to put exit planning into practice. At the bottom of the second paragraph, you can see, and I've seen this in other studies as well, that an estimated 75% of business owners profoundly regret selling their company just 1 year later. Now, one thing that people may not know about me is I actually have a bachelor's degree and a master's degree in psychology. I have two master's degrees, one in accounting and one in psychology. And I know that sounds like a very unusual combination. It probably is, but it makes me very strong as an exit planner to really try and understand and tap into the more emotional side of exit, which is certainly something we're going to be talking about today. I will actually go ahead and transition to this slide. I found this very interesting. I saved this article earlier this year. It was just posted to CNBC's website. And this couple here, this is a real life couple. They sold their company for $745 million. So obviously they are not concerned about the financial side of their exit. But they sold their company to Salesforce. But they said they just felt numb after. We couldn't process it. And as part of this article, they went on to talk about that losing a sense of purpose after selling a company. And then there are some other examples here of real life owners that sold for incredible value. And I think from the outside, most owners don't even get to sell their businesses. Many sell for what could be considered a successful transition, but much, much smaller numbers at this that can still work. But what we see is that the transition is so much more than the sale price. It can be difficult. So again, it's just an interesting concept to me with having this behavioral psychology background, and I really do try and tap into that and express that when I'm working with owners. So that leads us here to, the business sale, approaching it on the front end, hopefully. Otherwise, you're looking at it at the back end and not as prepared, that it is a massive shift. We're looking at a shift in net worth structure. Business capital is now financial capital, and it must generate income. So you generate your income from your business, whether it's through salary, distributions. Now it's been an illiquid asset that's generated income for you, but not really been an asset you could tap into. And then we're shifting to this concentration risk from one large, highly illiquid asset to more liquid investments. And this can create both opportunity and feelings of vulnerability, lack of control. Whereas you can go into the office every day and really kind of touch things that are more tangible. Once you transition out of that business, things may feel a little less under your control, and you're more subject to things like market risk and economic changes. You have a shift in your investment strategy. You may be changing from a growth focus as you're building your retirement accounts and saving, in taxable accounts perhaps, to that income focus. You don't necessarily have more income coming in. Shift in tax planning. Yes, I am a CPA, so this is a big part of what I talk about as well. And I just made a comment here, consider asset buckets for planning, and we'll be looking at a little bit more when we get into the software that I use for financial planning. Shift in cash flow management. Income will now have to come from your portfolio assets. Shift in mindset, moving from business owner to asset manager. Shift in role and identity. Who are you now that your role as owner is gone? Shift in scheduling. I don't know many owners that, are going to sit there on the proverbial rocking, in the rocking chair on the porch. I mean, the owners are dynamic people that have grown companies. They're creative, they're driven. And so once you transition out of your company, really, what are you doing with your time now? And a shift in purpose. So does this transition feel like an ending on the front end? Are you looking at it with apprehension saying, I don't know what my next step is? Or can you consider it, especially with some time, hopefully ahead of exit, to really be thinking not only of the financial side, but what's next for you as far as purpose, role, identity, scheduling? There is a great book out there by David Brooks called The Second Mountain that I highly recommend to anyone that's interested. in considering the more emotional side of transition as well. So now we're gonna get put on our brainiac glasses and our thinking cap. And I'm not gonna go into a ton of detail here, but I will talk a little bit about the tool that we use at GenCrest. We have partnered with a company called Quist, and they have two different assessment tools that they use. So we have an assessment tool for Quist on our website, and I'm going to show that here. I have to do the screen share, so hopefully this goes well. There's the initial tool, which is called Spotlight. So it's a pretty simple tool, and that's the one we're really going to be delving in today. And then they have a more advanced tool that we have access to, where we can work in a much more comprehensive way with an owner on more the value acceleration side. And the owner has their own login, and it's a year-long engagement where can do a lot more work. But we're going to focus on our insight, which is a spotlight check today. So what does this tool do? It uses recent industry multiples based on your industry code and geographical location. Gives you just a rough estimate of value based on adjusted EBITDA. So keep in mind, this is not a formal business valuation. I believe strongly in business valuation, and we certainly partner with valuation specialists that can help owners. They really need to get a valuation. This is just an initial, if someone's wanting to get a snapshot, especially the fact that it can use industry data as well. It will show a profit and value gap and an estimate market value using the market-based approach. What our tool does not do, it does not consider future growth potential or unique attributes or disadvantages. It doesn't consider possible discounting for internal sale. That could be to existing partners, employees, and families. So, looking at maybe more of a values-based sale versus a strategic sale. Account for discounted cash flows. Our more advanced tool does have consideration for discounted cash flows or specific risks to that business or industry. It doesn't consider asset value. So again, we're looking at a market-based approach here. So it's not going to look at asset values that are owned by the entity or outside real estate holdings that may need to be considered as part of the sale, or provide comparisons that would be more specialized for industries or companies. This is just a snapshot of one of the pages that this report shows. And so I am going to do my best to pivot, fingers crossed, and there we are. This is our GenCrest website. So this is our homepage, gencrestcapital.com. You can see all of our tabs here at the top, and we have a special tab for exit planning, which I encourage any owners to go to. Lots of Q&A on here, and just talks about the importance of exit planning and the work that we do. And you can see here the Spotlight Insight Assessment tool. So it's available that I can send this to anyone as a link, but also someone can go in and do it themselves, and then I can get the report. So yay, we did that, and now we're back here. So whether you have a formal valuation or you have done something like our Spotlight just to kind of get a starting point number, then we really want to get to the take-home number. Because there's such a difference between what let's just use EBITDA as example, what that number is for a particular year, and then you can take it over a period of years, and then you have trends, and then what is your multiple, what is your industry, and then you're still looking at this big picture number. But that is not what you're going to ultimately take home for your personal investments to be able to use post-exit. So it's really important to say, okay, I'm starting with, this point, and then I'm looking at possible multiples. Wow, that starts to get some big numbers. I'm really excited about that. Okay, well, take a pause, take a beat, as the kids say. So let's just take into consideration some of the things that are going to get us to the number that we would need to potentially use for a cash flow perspective on personal financial planning. So we might start with a gross sales price and then look at subtracting broker fees, which could be flat or tiered, subtracting legal and accounting fees. Big one potentially here or not. I have seen it certainly both ways, and I have seen that sometimes it's something that people are not taking into full consideration on the front end, which could be outstanding business debt. I'll also say I work with owners oftentimes that have outside real estate holdings, and it's the same thing. If they're looking at the real estate, do you have a mortgage on the property? It needs to be considered. Subtracting closing costs. And then last but not least, this is again, as a CPA, something that I'm looking at carefully, subtracting taxes on the sale. These can be significant. You want to understand the different types of taxes. Are you looking at ordinary income taxes? Are you looking at long-term capital gains taxes? Are you looking at a combination of both? And in particular, if it's an asset sale, is there consideration for depreciation recapture? And I would add again, when selling outside real estate, oftentimes a company owns their real estate in a separate entity and they've been taking depreciation on that building, possibly with a cost seg, which has helped them on the front end, cost segregation study, allowing them to break out depreciation, could be in the business, could be in outside real estate. But to understand that there could be also some depreciation recapture on the sale. So then we're hopefully getting closer to our take-home number. All right, so let's transition. Let's say now we have an idea, an estimate again, when are we going to sell? We're not sure, is it going to be next year? Are we looking at 3 years, 5 years out? What type of, sale value are we looking at? And I think of it kind of like what came first, the chicken or the egg. Are you aware of what your net sales proceeds are going to be first? And then you're backing into cash flow? Or are you really looking at cash flow and saying, what do I need that number to be? For me, it's a little bit of both. It's a little bit of give and take. So whenever I'm talking to owners, I always want to make sure that we're thinking about what you have been paying out of the business. And possibly in terms of benefits, or also just what you've taken out in distributions that you may not be thinking of that you would need to now pay for from savings and investments. You can see that the very first thing that I have listed here is health insurance. It is potentially a very big number, and we're currently in a bit of a state of uncertainty with health insurance. And we're here in December 2025. And at the end of this year, the marketplace subsidies for over the 400% poverty level are scheduled to go away. So whether or not that remains will be seen. But as of right now, starting at the beginning of 2026, there is a cliff that you are either receiving subsidy or you're not. And if you're not receiving subsidy and you need to get health insurance through the marketplace, through the health insurance exchanges, it can be extremely expensive. So if you've been paying for health insurance, most likely through your company, that's a big consideration, especially for our younger owners that are looking at sale. Vehicle expenses, life insurance, cell phone, meals and travel. So those are all kind of things that I encourage owners to think about. One, in terms of how you're getting to your potential sale number. If you have really high, what we would call seller discretionary expenses, if you've been paying for a lot of things that could be considered personal out of the business, one, that could potentially affect your sale price. And then on the flip side, you need to think about those things that you would need to start paying out of your own cash flow once you've sold the business. What additional goals do you have when you sell a business? This is a big one for me, and it can be quite fun to talk through. And again, this gets to maybe hopefully getting an owner excited about life post-transition. But how do we fund those? Do we need to build in, if you're working all the time and what do you want to do afterwards? I put home improvement projects because in my experience, when people retire, a lot of times they spend the first 2 or 3 years catching up on all the home improvement projects, maybe remodeling, things like that, and they can be expensive. These projects can be expensive. The other one that comes up certainly is more travel. A lot of times, especially if people are younger, they say, one of the reasons that I wanted to sell this company is to spend more time with my family. A lot of times, travel costs may not just be for the owner and potentially a spouse, but I find a lot of owners want to cover travel for their family, for their kids and grandkids, and really take the time to create memories together now that they have more time. And that can be at a significant cost. So we want to be thinking about those. Other owners that I work with say, gosh, I've always, wanted to have a second home at the lake, or, we're thinking about buying an RV and traveling the country. So, those things all can be great. And hopefully an owner has a sale that allows all those things to occur. We just want to build them into the planning. The last thing we want to think about is that we need to have assets that are not just meeting our current income needs, but also providing growth for the future. So, an overview of the safe withdrawal rate. So some people may be familiar with the safe withdrawal rate. For those of us in the financial planning world, it can be a controversial topic. I actually really like the idea of the safe withdrawal rate when I'm working with clients as just a guideline. I guess the debate is the 4% is the classic guideline, and so it's like, is that the right percentage? I think it's a good starting point, and it's something that people can understand conceptually. So just to keep it simple, if someone has $1 million, a 4% safe withdrawal rate would say that you could pull $40,000 from a relatively growth-oriented portfolio and have a portfolio that in good times and bads, ups and downs with the market, that you would have a portfolio that would last 30 plus years in retirement. So keep in mind what I was saying, that a lot of times owners are in a position to be able to retire earlier than the classic retirement age, which would be, in the mid 60s, ages 62 to, 67, 68. I've worked with owners that are looking at retiring in their late 40s or early 50s, or at least looking to sell their business. They're going to have a second act. But, when we're looking at someone who is younger, I think the younger that you are, or if you have a lower risk tolerance, then that's where we need to maybe tweak that safe withdrawal rate. It may need to be below 4%. For someone who is older, or or for someone who's younger, it says, I'm really willing to take on some risk. I'm going to have some other income sources early in the earlier years. I'm still looking at this for later on. Okay, well, the safe withdrawal rate that we would be looking at in those later years, it could potentially be higher. Don't forget also, when you're thinking about how much you need to pull from the portfolio as you're structuring investment income, that you need to be looking at structure income for returns and also cash flow distributions. So I talk a lot about buckets. I think about buckets for tax planning, and I also think about buckets in terms of, what do we need to cover income maybe for the next year, certainly. Then beyond that, the next 3 years, 5 years, 10 years, we may have assets that are positioned for a little bit more growth, and also therefore a little more volatility, a little more risk. That would be our assets that we may not need, that can ride the market, that we wouldn't need right away. Whereas assets that would be needed more in the shorter time frame, we would want to consider keeping those more liquid and more conservative. What other income sources do you anticipate? So when we're looking at a safe withdrawal rate and you say, I've got this portfolio, I was just speaking to, an owner that may be selling earlier in their mountain. Let's say they're, their second mountain. They might have a third mountain, a fourth mountain. What's their next act? And a lot of times I find there are owners that are looking to, they still have a real estate portfolio. They're looking to get involved in another company. They're going to stay engaged with this company on a consulting basis. They want to do some other type of work. So all those things could bring in additional money to where we could lower that withdrawal rate. And then later in life, in retirement, you may be looking at pensions, life insurance, cash value, annuities, and Social Security. So creating your financial plan ahead of time. Again, I really, just like I say all the time, exit planning is just good business planning. I also think that applies when we're looking at the financial plan. So I love engaging with owners, ideally at least 3 to 5 years out from sale. A lot of times they're cash flowing really well while they're running their company, and they want to, get a head start on the financial planning, really be putting money away while they can, doing it strategically, thinking about tax buckets, things like that. And that's where we can start to build the financial plan on the front end, and also then incorporate in the potential liquidity event for their company and project that in, and how does that look? And so that's what we're going to look at next. But whenever I'm sitting down with someone the first time, I say, you're a business owner, and you understand that your business has a balance sheet, which would be your assets and your liabilities. And then you have your income statement, which would be your income and your expenses. So we want to think about our personal financial planning the same way. So on the personal side, we have our assets, home, additional real estate, the business that they own, investments and savings. And I put a comment here, treat as buckets. The liabilities that you may have, mortgages, home equity lines, credit cards, car loans. Those are all opportunities for planning a lot of times of how we're going to balance those liabilities with funding goals. Income and expenses. So whereas assets and liabilities are, I'm going like this, I view assets and liabilities as more of a vertical. It's more of a snapshot in time. Then we have our income and expenses, and that's more of a horizontal. So that is over a period of time. And think about that as an owner. Think about, if you run a report from QuickBooks or whatever accounting software you use, and your balance sheet, you say, I'm going to do it as of this date. I'm going to do it as the end of the quarter, the end of the year. And you're taking that snapshot in time. What is everything that I have? It's linear like this. And compared to our income statement, which would be, I'm going to take it from this period of time to this period of time. And it's important to think about the income and expenses, because it is over a period of time, and say, how much, just like you do with your business, how much income am I bringing in, and how much am I having to take out for expenses? And from there, you will always have some sort of surplus or deficit. How much is it, and what do we do with it? So just like you're thinking about that strategically as an owner, if it looks like you're going to have a surplus, you're thinking, gosh, do I need to hire? Do I need to buy some additional fixed assets for my company? Do I need to put more into marketing? Am I going to have to pay additional taxes? Or if you have a deficit, where do we need to pull back? It's the same thing for your personal financial planning. And I don't think a lot of people really think about this, but if we have a surplus, and I find a lot of times owners are having a surplus, what do we do with that? How can we be strategic about that on the front end? And then it also applies after liquidity when you're taking cash flow. Are you looking at running a surplus or a deficit? How much? How is that going to impact your long-term planning? I made a comment in here to look at tax strategy again. So post-exit, and I'll be showing an example that, are you maximizing what you can do on the front end as far as taxes go? Looking at, pre-tax, putting in pre-tax funding into retirement accounts, or on the, considering things like Roth conversions. So again, that's not specific tax advice or financial advice, but these are things that come up that need to be considered. So with that, I am going to show, this is the internal, so this is where you get to see the sausage made. This is a system called eMoney, and I have been working with eMoney software actually long before I was with Gencrest. I first had an introduction at a previous financial planning firm we used eMoney with our clients there. I probably started using it around 2009, 2010. So I have been working with this software for a very long time. I consider it an integral part of the comprehensive and robust personal planning that I do, and it works great for business owners. So don't have to use this particular software, certainly, but it's the system that I use, and I think it can illustrate well. Here we have an example. So this is just a sample client, Bob and Maggie Entrepreneur. And you can see here in the blue box that they have a net worth currently of $15 million, over 15. And their investments, what we would consider liquid investments that could include retirement accounts, taxable investments, cash savings. That's just over 2 million. So here we see Bob and Maggie at a point that they still own their company. They have a highly illiquid asset. Their net worth looks great on paper, but yes, they're hopefully their business is cash flowing well. But they cannot take that business to the grocery store and buy groceries for the week. So I would say that Bob and Maggie have done a good job of saving. You can see Bob has his 401k here. They've got some taxable managed accounts. They've got a pretty good emergency fund, and then also, Maggie has her 401k. They've got some whole life cash value. Okay, so this is our starting point, and then I'm not going to go too in the weeds with this, I promise. But this is where I go in and I really build the planning. So you can see that we can put in specifics for property. Again, let's think about our assets, property, investments, business interests, potentially cash value, life insurance, notes receivable. So those are our assets. Can go in and build these very precisely with, projected rates of return, additional funding for retirement plans or taxable assets. Can show rental property. We can show various entities. So it works great for a business owner. I really love it because I can show, their real estate owned by the partnership and, the business, this S Corp, and build it out, and then show the business being sold. Liabilities, so those could include, things like the mortgages, the credit cards that we were talking about, income and expenses. I'll highlight this, that whether I'm working with owners or a non-owner client, there's a worksheet here, and I actually have created a template that I use with clients that I find to be really helpful, because I think a lot of times people don't understand what all their expenses are. Usually it's kind of like dieting. What you think you're doing, when you actually start to keep up with it, you think, oh gosh, this isn't enough. So I find usually on the first run through, the expenses can be kind of lean. So I've come up with this so people are really thinking about all the different types of expenses that we have. And then I have a way to put them in. If it's less than annual, get a multiple. I'm looking at annual numbers, notes. So I find this to be a really helpful spreadsheet to get people started on cash flow budgeting. We can think about the ways that we want to pull down our assets. And again, that gets into tax buckets, and then savings and transfers. So I will not go into a lot of detail here, although we can. And I want to just show really quickly the cash flow report. So this is, again, if I'm building out a financial plan for an owner, this is showing the base facts where Bob and Maggie do not sell their company. And a lot of owners don't sell their company. This is going to illustrate the importance of trying to building a valuable company and selling. So if they try and go ahead and retire at this point, where this the star is Bob's retirement, says down here, you can see that if they keep their current lifestyle where it is with expenses in place, they do not have enough to last their lifetime. Now that's probably a pretty dramatic example. Hopefully not the case, but certainly there are a lot of companies and owners that build a successful and profitable company that for whatever reason don't sell. So we want to really be able to look at that and say, all right, if an owner said, I really just don't see myself selling, I think I'm just going to close the doors. Okay, well, what might we need to do to change do you need to work longer somewhere? Would you need to look at reducing your lifestyle expenses? That's where that conversation would go. In this example, you can see here with the box that I'm clicking that we have multiple scenarios that I'm able to build in this financial planning software. So this lets us get into the what ifs. And I find this to be extremely helpful with my owners if we are looking at different options. And you can see I'm scrolling through them here, looking at installment sale, maybe selling half of it now, selling half of it later. Selling it and investing the proceeds. We could look at different rates of return. So lots of different options. So as a starting point, we can look at retire early with installment sale. Now we can see we have a much better outcome. We get down here and we can do even a deeper dive into the types of income, looking at required minimum distributions, our expenses, net cash flow. Again, that gets to our surplus income after, income minus expenses. Are we running a surplus? Are we running a deficit? This column here shows us net cash flow. This is where I look to say we've got a good surplus, and then do we start to run a deficit? And if so, why? This is where we can get into some strategic cash flow planning and tax planning as well. So then we have our portfolio assets over here. This is also helpful because we can look at multiple scenarios and actually compare them together. So you can tell those of you listening who've made it this far, I promise I'm going to stop geeking out on this, but this is so fun for me. I love doing this part. I love sitting down with owners and having this dynamic way for us to not just say, well, what if this and what if this and how does that look? But we've really fully built out their plan. And I find, so here you can see we have two examples side by side. And I really like this because sometimes I find that when we're doing personal planning, people can get stuck on something that feels very significant to them financially. And we can look at it through this lens and say, maybe this is more of a value decision for you. It may feel like a big decision, but it's not having a huge impact on your long range planning. So then you can say, well, maybe it's something that you think about more from a value perspective. And I would even say that that can lean towards the sale itself. I've worked with owners that are considering, do I look at selling to someone internally, which may not bring me as much on the exit, but gosh, this employee or, my family member has been with me in this company for a long time. Am I going to look at helping to fund this? Am I going to look at doing an installment sale, which is our example over here on the left? Am I going to help fund this installment sale versus have a sale, to maybe a partner where there's a buyout over time, or looking at a full outside strategic buyer that may be the biggest price? Well, if we can run the numbers and say, it looks like these options work. You're not going to get as much for the sale. Maybe it's more of a value-based decision. Or gosh, you really are going to be dependent on this for the success of your financial plan. You need to really think about that. So that's why I love this software. It's not a sales pitch, I promise, but I just find it so helpful to not have it me say, this is my opinion, or I think, or you should think. I say, based on these projections, and based on these assumptions, and we can make changes from there. So moving forward, steps to take before exit, 3 to 5 years out, ideally. You're developing a plan and you're meeting with members of your exit team. I mentioned this before, it's CPA, attorney, financial planner, insurance agent, and possibly also, a SEPA like myself. I'm a financial planner. I don't really focus, I'm not solely focused on the value acceleration, but there are some great advisors out there that are. Love to partner with them. Estimate your net proceeds number. Does it look sufficient for your projected needs? And let me go back to the exit team, and I'll just say this. I've worked with so many owners that tell me, I didn't really communicate to my CPA, for example, on the front end that I was looking to do this. And so we bought a bunch of assets and depreciated them the year before sale. So things like that, or CPAs telling me, gosh, I wish I'd known this, we would have done some different planning if we had known. So that's where it really is. all the advisors that I know really like a team approach. So I think if you say, hey, you've been with me leading up to this exit, I really want to make sure we have all of our heads together. People have different talents. So again, next one is estimating your net proceeds number. So not just thinking about the sale number, but what does that number translate to you for your personal financial planning? Does it look sufficient? Reviewing your cash flow needs post-exit on the front end. Considering what your net assets are going to look like, working to continue to improve your enterprise value for sale. So what can you do to spruce up your, thinking about if you're selling your house, you maybe spruce things up a little bit. You want to present the best foot forward for an outside buyer in terms of internal culture, processes, procedures, not having a super owner-centric company. Be thinking about all those things on the front end. What are your personal plans post-exit? So we certainly have talked about that today, and I just cannot stress what an important part of the process that it is. I have talked to so many owners, and we looked at the examples of these huge sales, and owners felt adrift after sale, and I can say I've seen that with my own practice as well. How will you fill your days meaningfully? And lastly, maximize savings and investments while still working. So strategically, if you're cash flowing really well with your company, a lot of times I'm working with owners and they are cash flowing really well. How can you maximize what that means for you? One last consideration, legacy planning. So the name of our company is Gen Crest. We formed the company name last year when we rebranded with intention, and it's for generational and family crest. So we really are focused on family planning, oftentimes multi-generational planning. So I think it's important to consider legacy planning, especially for a significant exit. If it looks like you're going to have plenty of money to last beyond yourself, where do you look beyond that? What do you want your money to do for your family? Big one that we work on here, how do you prepare your children for inheriting wealth? And considerations for gifting and philanthropy and estate planning strategies. So that is it for my presentation. I want to just say thank you to everyone who has attended the roundtable. I came up with this crazy idea at the beginning of the year to do roundtable, and it's really been fun and rewarding, and I've loved engaging with other advisors that focus on the exit planning, business owners, as well as the owners themselves. So I thank you very much. I'm going to stop the recording and then we'll move on to see if there's any questions or comments from our participants today. Thank you.